In March 2020, the S&P 500 dropped 34% in 33 days. Most investors panicked. They sold. They locked in their losses and sat on the sidelines waiting for things to calm down. But one investor, a retired school teacher from Ohio, did nothing. She held 5 ETFs she'd been building for 14 years. Her portfolio dropped over $80,000 in value in those 33 days. She didn't sell a single share. 12 months later, she was up more than the losses she'd suffered, and she was still collecting passive income, automatically, without touching a thing. Here's what most people miss about that story. It wasn't about courage. It wasn't about discipline. It was about what she owned. She owned assets that were structurally designed to survive volatility, keep paying her, and compound through the chaos. She didn't have to make a smart decision in March 2020 because she'd already made the right decisions years earlier. That's what this video is about. I'm going to show you 5 ETFs, one from each of 5 key investment categories that are built to generate income, grow over time, and survive the inevitable downturns that will happen between now and the day you want to stop working. This isn't a get-rich-fast list. None of these ETFs will double your money in a year. What they can do is this. A $10,000 investment in the right combination of these funds, left alone for 30 years with dividends reinvested, could realistically compound to $400,000, $500,000, or in one case, approaching $2 million. We'll go through the math together. We'll also cover why most people pick the wrong ETFs, not because they're uninformed, but because they're focused on the wrong metrics. Let's get into it. And this is the one most people overlook. The goal of a defensive ETF isn't to generate huge returns. It's to hold the floor when everything else drops. It's the part of your portfolio that keeps you from panic selling. In this category, the ETF that earns its place is IHF, the iShares US Healthcare Providers ETF. Here's why healthcare works as a defensive anchor. People don't stop needing insurance, hospitals, and medical care during a recession. Demand is structurally stable. Revenue doesn't evaporate when the market falls. IHF's yield is modest, currently around 1.06%. If you're looking for big income right now, this won't impress you. But look at the dividend growth rate over time. Since inception in 2006, IHF has delivered an average annual return of about 8.5%. And because this ETF concentrates on healthcare providers specifically, companies like United Health and CVS, it tends to hold up better during economic stress because the underlying demand is non-discretionary. The income story here is really about compounding over time, not yield today. The dividend IHF pays you in year 1 might be modest, but because it's tied to businesses with durable pricing power, insurance premiums, pharmacy benefits, hospital billing, that income grows consistently. The trade-off, IHF is concentrated. Its top 10 holdings account for over 73% of assets. That concentration creates volatility. It's had drawdowns of around 28% in rough patches and can take nearly a year to recover fully. But if you understand that going in, it doesn't scare you. Healthcare providers aren't going away. The demand is permanent. The volatility is the price you pay for the stability of the underlying business model. IHF earns its place in this portfolio not as an income generator today, but as a structurally stable foundation, the kind of holding you can own through volatility without second-guessing yourself. ETF number 2, Income, SCHD. The second category is income, and this is where I see the most confusion. Walk into any personal finance forum and someone will be raving about an ETF yielding 11%, 12%, sometimes 14%, and people flock to those numbers. Here's the thing, yield is not income. Yield is a snapshot. What matters is whether that income is growing, sustainable, and keeping pace with inflation over 20 or 30 years. Take a fund like MORT, which tracks mortgage REITs. The yield looks incredible on the surface, over 11%, but its dividend has been shrinking at roughly negative 3.6% per year over a decade, and its share price has fallen on average over that same period. You're collecting income while the asset underneath it quietly disappears. That's not a passive income stream. That's a slow bleed. SCHD, the Schwab US Dividend Equity ETF, is the fund that gets the balance right. Its current yield is around 3.2%. That's meaningful income immediately. But more importantly, SCHD's 10-year dividend CAGR is approximately 10.7 to 11.5%, depending on the period measured. That's a dividend that has nearly tripled over the last decade, from roughly $0.35 per share in 2015 to about $1.05 per share by 2025. At that growth rate, the income doubles roughly every 6 to 7 years. You're not just earning, you're earning more every single year. The total 10-year annualized return with dividends reinvested has run about 13% annually. That means $10,000 invested 10 years ago in SCHD is worth around $34,000 today, with an increasing stream of income the entire time. Look at the current holdings. Texas Instruments, Qualcomm, United Healthcare, Coca-Cola, Merck, Chevron, Procter & Gamble, Amgen. These are companies with durable free cash flow that have been raising dividends through recessions, rate hikes, and pandemics. The portfolio has never cut or frozen a dividend since SCHD's launch in 2011, not once. On a $10,000 investment, year 1 produces roughly $320 in dividends. By year 10, that grows to around $800 to $1,000 per year. By year 20, north of $3,000. And by year 30, with dividends reinvested, the portfolio itself could be worth well over $400,000, generating over $20,000 in annual income. That's what growing income looks like. The yield you start with matters far less than the trajectory. The next 3 ETFs are where the compounding starts to accelerate. ETF number 3, Global Diversification, FNDF. Most investors are 90 to 95% invested in the US market, which makes sense. It's been the strongest equity market of the past few decades. But single country concentration carries a risk that's easy to ignore. What happens if the US market goes sideways for a decade? It has happened before. Between 2000 and 2010, the S&P 500 returned essentially zero. 10 years, nothing. Meanwhile, international markets have had their own 10-year long runs where they significantly outperformed. Right now, in 2026, we're actually seeing international stocks outperforming the US for the second consecutive year. A reminder that geographic diversification isn't just theory. Global diversification isn't about chasing foreign growth. It's about not having all your eggs in one geographic basket. In this category, the ETF that earns its place is FNDF, the Schwab Fundamental International Equity ETF. What separates FNDF from standard international index funds is how it selects stocks. Instead of weighting by market cap, which tends to overweight expensive, overvalued companies, FNDF weights by fundamentals: sales, cash flow, dividends, and book value. It favors companies that are actually profitable, not just popular. The ETF holds nearly 900 companies across industries like financials, industrials, healthcare, consumer goods, energy, and materials. Top positions include Samsung, Shell, Total Energies, Glencore, and Toyota. Its top 10 positions make up only about 14 to 15% of assets, far less concentrated than most ETFs. The numbers: a trailing dividend yield of approximately 3.0 to 3.4%, and a 10-year annualized total return of roughly 9.3 to 11.7%. Sources vary by measurement period, but the direction is consistent. Over the past year alone, FNDF returned over 38% with dividends included, reflecting the current tailwind for international value stocks. Its volatility is lower than many international peers. During market declines, it historically loses less than the overall international market, and it has recovered relatively quickly from its drawdowns. On $10,000 invested, with dividends reinvested and compounding over time, the 10-year projection approaches $24,000 to $30,000 plus, growing further from there. The international diversification isn't just about returns, it's about resilience when the US market enters one of its inevitable flat periods. ETF number 4, Market Exposure, SPY. The fourth category is market exposure, the backbone of the portfolio. You've probably heard of all 3 candidates here: SPY, QQQ, and VTI. QQQ has delivered strong raw performance over the past decade, but roughly 60% of it is concentrated in technology and communications. When sentiment shifts, the drops are sharp and deep. It's an accelerator, not a foundation. VTI owns the entire US market, over 4,000 companies, maximum diversification. But it also includes thousands of small and mid-cap stocks that add noise without meaningfully boosting returns. You're diversified, but you're also diluted. SPY tracks the 500 most profitable, most dominant businesses in the US economy. Apple, Microsoft, Amazon, Nvidia, Berkshire Hathaway, companies that generate real cash in real businesses through every market cycle. The dividend yield is about 0.97%. The income story here isn't about yield, it's about price compounding. Over the last 10 years, SPY has delivered an annualized total return of approximately 15 to 15.6%, with dividends reinvested. That's significantly stronger than the long-run historical average of about 10.5%, reflecting a decade that included massive gains in 2019, 2021, 2023, 2024, and 2025. A $10,000 investment in SPY 10 years ago is now worth roughly $42,000 to $43,000. It moves with the economy, it compounds consistently, it has recovered from every single drawdown in its 30-year history, including a 34% drop in 2020, a 19% loss in 2022, and the 55% crash of 2008-2009. This is the engine of the portfolio, not the flashiest, but the most reliable. ETF number 5, Concentrated Growth, VGT. The fifth category is where most investors either overexpose themselves or ignore it entirely. Concentrated growth. This is the part of the portfolio where you're intentionally accepting more volatility in exchange for the chance at significantly higher long-term returns. The ETF that does this best is VGT, the Vanguard Information Technology ETF. VGT is concentrated by design. Its top 10 holdings, Nvidia, Apple, Microsoft, Broadcom, and others, make up roughly 54 to 60% of the fund. That's not a flaw, that's the point. Over the past 10 years, VGT has delivered an annualized total return of approximately 24 to 25%. For perspective, $10,000 invested in VGT 10 years ago is worth roughly $85,000 to $90,000 today. Total 10-year return over 849%. The upside capture ratio is about 139 to 140%, meaning when the market goes up, VGT tends to go up considerably more. Since inception in 2004, VGT has returned about 15% per year total, turning $10,000 into over $228,000. The income is minimal, a trailing yield of around 0.33%. This is not an income fund. Everything here is about price compounding. The volatility is real. In 2022 alone, VGT fell nearly 30%. Drawdowns regularly reach double digits. In 2008, it dropped over 40%. This is not a fund you watch every day without nerves. But over a long time horizon, that volatility becomes irrelevant. What matters is direction, and the direction of enterprise technology spending, semiconductors, cloud infrastructure, and AI has been persistently upward. The compounding curve is exponential. The first 15 years feel slow, the last 10 years change the picture entirely. At a historical rate of roughly 20 to 25% per year, a $10,000 investment over 30 years, if the underlying trend in technology continues, could approach or exceed $2 million. The math gets wild at those rates over long periods, and that's precisely why time in the market is everything. You can't replicate those final years by starting later. Here's what took me a long time to really understand about investing. The returns aren't the hard part. The math is simple.